Hello, this is Market Pulse by Faster Forward from Northern Trust Asset Servicing. My name is Marc Mallett. I'm the Chief Strategy Officer for Asset Servicing, and today I'm joined by Grant Johnsey, Head of Client Solutions, Capital Markets, North America. And Grant, welcome. It's great to have you back.
Thanks, Marc.
I know today we're going to be talking about a number of topics. We're going to focus on energy, AI, interest rates, and maybe we'll get to a few more things. So exciting stuff. I think we can dive right in.
I'm looking forward to it.
Awesome. So look, our clients are focused on more investments in energy, wondering, is Northern Trust adding any additional services to help in those areas?
Yeah, absolutely. We're seeing a real increase in energy interest right now on the investment side. So it's something that we're continuing to put resources and energy into. So we'll have some press releases coming out soon in some of the work that we're doing. But it's an area right now that we're seeing a lot of demand in from our client base. And so it's something that we're going to continue to put some investment in our side too.
Well, I guess what's behind that? Why is there growing interest in energy from an investment perspective?
Well, I think the first thing is that energy isn't just an input into the economy. Energy is the economy. If you really look at how humans have evolved, it's really around energy, and our lifestyle is ultimately a reflection of how well we're using and exploiting energy, right? So I think that's where I would start and we've gotten away from that. So energy has not been a big area of investment recently, and as a result, energy assets are very cheap. It's less energy stocks are less than 5% as a sector in the S&P 500 right now. But interestingly, energy stocks have actually performed very well over the last 4 years, since even going back to 2020, but especially since 2021, they've outperformed over those time periods, even technology. The other interesting thing about energy right now that people are realizing is that it's a low correlated investment. Bonds, as we've seen recently, have actually had some positive correlation to the equity markets and have actually in some ways been as volatile as the stock market. So energy is a way to decrease your correlation to the market. Granted, a lot of that happened in 2022 when the broad market had a weak year and a sell-off, and energy stocks did very well. But even this year, right, the stock market started very strong in January and Feb. Energy stocks were pretty flat over that time period. And then in March and even into April, you saw energy stocks come around when there was a little bit of softness in the equity market. So even now, I think you're still seeing it be a lower correlation in the investment universe. We also are going to expect to see demand for energy increase a lot for a variety of reasons, which we'll get into. And then lastly, energy is a very good play in a higher inflation environment, which is something we've talked a lot about in this podcast.
Yeah, there's a lot of talk about renewables and trying to transition to green energy or the energy transition. Why will that pivot actually create sort of more demand for, I guess, almost legacy energy?
Well, it's a few different reasons that the pivot to renewables is actually going to, at least in the interim, increased energy demand. The first is that renewables have what's referred to in the energy industry is low capacity factors. So what capacity factor is the actual output of energy relative to the amount of energy that's capable from that energy source. So to put things into context, a nuclear power plant operates at north of 90% capacity factor, meaning that if you have a 500 megawatt nuclear reactor, right, you can get pretty close to 500 megawatts on a consistent basis out of that reactor. Very high. You can continue to have that reaction on a sustained basis. Coal, oil, natural gas power plants tend to have capacity factors that are 50 to 60%. All right, so nuclear hydrocarbons tend to be relatively high. Wind is the highest of the renewables. It's 40 to 50% capacity factor, right? You think about a windmill. If the wind's not blowing or not blowing as strong, it's not going to generate as much power, regardless of what it's capable of doing. Hydro has the biggest variation. So it's variation because of depending on what's the rainfall and how much water is coming from behind. So a hydro plant will have 25 to 50%. Capacity factor as an example, the Hoover Dam is closer to 25 because it's been droughts. The big dam, the Three Gorges Dam in China is closer to 50%, production of energy relative to its nameplate capability. Solar is the lowest. It's 20, 25, 30%. You think solar, you can't even use it at night. So that takes half of your capacity out. So when you're thinking about renewables, you're going to have to heavily invest in those renewables because the capacity factors are much lower than conventional energy sources. You're probably also going to have to layer different types of resources. So at night, you can't rely upon solar. So you're either going to have other power supplies, or you're going to have to invest heavily in batteries, right? All very expensive. It's all going to require a lot of energy inputs to build this. So that's two of the big reasons. And then I think the third one is much of the renewable supply chain is dominated by China. China dominates the supply of rare earths for batteries, silicon, polysilicon for solar. For the U.S. to start building that, or the West for that matter, start building it, very, very energy intensive. I'll give you one quick fact on polysilicon. Polysilicon is one of the most important materials in solar panels. And what it is, it takes silicon, which is one of the most common elements on the face of the earth, but you have to get that silicon to 99.9999% pure. To do it is extremely energy intensive. There's very few polysilicon plants in the United States because it's so labor intensive and because it's a low margin business. There was one in Montana that just recently closed because the cost of electricity was too high for them to operate. One of the biggest is in Michigan, and it generates or uses more electricity than any other operator in Michigan. In fact, at peak, it takes about 500 gigawatts of energy to run the polysilicon production at this plant in Michigan, which is roughly the equivalent of Ann Arbor and Lansing combined. So a population of 250,000 people is what this plant takes to make polysilicon. So to do those onshore or to take them out of the hands of China or other players that we don't want to do business with as much is going to be very expensive. So we're going to actually probably use more energy to get to this pivot to renewables for those reasons.
And so I just did the simple math when you look. So if hydro is around 50% and and solar's down around 25%, then you need effectively 4 times as much renewable energy sources to replace the legacy.
And they need to be layered because you're not going to get solar generated at night. You won't get wind generated when there's not as much wind. Hydro is going to decrease when you have drought situations. So yeah, you're going to have these layered as well. And so you're going to have more investment in infrastructure. We haven't even talked about the power lines to deliver that, right? The batteries to store power. So a big investment is going to be a lot of money. And ultimately, as I talked at the outset, right, all that economic activity is going to require energy to get us there.
All right. So speaking about energy, and a topic that's been discussed quite a bit, just it seems like in any discussion, whether it's around financial services or I suppose any industry now, is AI. What impact is AI having on the energy market?
It's minimal right now because there's just not that many AI servers that are out there being utilized, but we're early days. An AI server, by some of the estimates I've read, is anywhere between 8 and 10 times more energy intensive than a conventional server. All right. So if you look at a projection by Gartner Research, they predict there'll be about 2.7 million AI servers in operation by the end of 2027. So we're talking about 3 years from now. If you assume that you're going to use the common A100 chipset, which is from NVIDIA, and you kind of do the math, and I'll spare you the details of the math, but if you assume 2.7 million of those units operating by 2027, you assume they're going 24/7, and we're going to assume to start no efficiency gains from those, right? That's the equivalent of 153 terawatts of energy that those servers would need. To put that into context, that's more electricity than the entire state of New York uses in a year. Now, the reality of it is they're not going to run 24/7. There are probably going to be some efficiency gains. So if you have that, you're talking about maybe the electricity of, say, Michigan. So huge energy demands. Constellation Energy, for example, recently predicted that they believe that the energy demands from AI will vastly exceed that of EVs. If you look at Google searches, so Google's got about 9 million searches, I think, a day, or it's 9 billion a day. It's an incredible number. If that was done with AI, like Chat GPT searches, that would require not only a $100 billion investment, but I will also consume the amount of energy that roughly Ireland uses in a year. So these are big numbers we're talking about that I don't think people have really thought through. And it's another reason that combined with EVs, drawing in electricity, that there's a view from a lot of investors that energy demands are going to increase quite dramatically in the coming years.
Do you think that is going to slow, like the growth that we're seeing with AI? Right, there's so much promise about what's going to happen. Would could that drive up the cost of energy? Could it slow down the ability for these firms to make progress?
I think it's going to definitely drive up the cost of energy. I don't envision it slowing down the AI. There's a lot of slack energy supply that we still have in the U.S. and really worldwide. OPEC Plus, for example, has spare capacity of 5 to 6 million barrels a day that they're not, putting out right now that they're not tapping. The U.S. has vast oil, nat gas resources. You've got a lot of countries, Venezuela is a good example, Iran, even Russia, who all have declining levels of hydrocarbon output. I think we've got incredible opportunity in this country to harvest wind and solar, right? We're in a very unique position to be able to leverage that. So I think what will happen, though, is I think you will see the cost of electricity increase, right? And it's going to force people to really think about how they're using electricity, how they're obtaining it. And will also encourage more investment into energy, which is not something that we've seen a lot recently. I mean, right now we're below 500 oil rigs in the U.S. waters, for example, which is a relative low. So it'll probably encourage more of that. I think the problem is it's going to really put some pressure on reconsideration, unfortunately, of using higher emission energy sources like hydrocarbons.
Do you think there would be pressure on the grid? Like, so I hear all the time, like our core electric grid in the U.S. is, number one, it's not, we don't have a national grid. I know this company called National Grid, but there isn't a thing that is the national grid. It's regional, and it's aging. And so even if we could produce more energy, do we have the ability to actually distribute that energy to wherever these data centers are going to be?
No, it's a gap. If you look at any of the grid operators, like PJM recently came out and said, we're going to see increased demand for energy, and we don't necessarily have all the infrastructure that's there for it yet. The other thing to go look at is, anyone can do this when they go home and they look at their electric bill. My electric bill, at least more than half of my cost is actually the cost of delivering the electricity to me. And that has been getting bigger every year, and it's probably going to continue. So I think ultimately we have a lot of infrastructure that we need to invest in to make that happen.
And then I guess along those lines, so we know that energy demand is going to grow. What options are available to meet this additional demand beyond, I suppose if we were to continue to look at, sort of the existing sources of energy that, whether it's, oil and natural gas, are there other, areas to look at?
So nuclear is a big one. Nuclear, as I mentioned earlier, has a very high capacity factor. It's very reliable. There's actually been a lot of developments in, how nuclear power is generated, much more modern. We haven't really seen that in the United States. The nuclear power plants, the handful that have come online recently, like the one down in Georgia, is still using relatively older designs. The problem with nuclear is, one, there's a fear factor from the Chernobyls and the 3 Mile Islands. But I think the biggest issue actually is getting uranium enrichment. So a lot of folks don't realize this, but Russia controls about half of the uranium enrichment market in the world. The U.S. spends over $1 billion to Russia still to this day to access the enriched uranium that they are able to produce there. Bill Gates, for example, and so Bill Gates is someone I always look at when you're thinking about the intersection of energy, right, and technology. Bill Gates has actually invested into a TerraPower's name of it. It's a nuclear power company, and they want to actually build a modernized nuclear power plant, but that's been delayed, I think, at least by 2 years because they have a pledge not to buy enriched uranium from Russia. So that has been one of the key delays in that. So nuclear is definitely one. This has been talked about a lot, and that's one reason you've seen the price of uranium really spike in the last year and a half. It's come off a little bit from its highs, but that's why uranium's higher. Hydro is an interesting one. Look what's going on in Quebec, for example. So Quebec is investing heavily in dams right now to supply essentially the northeast of the U.S. That comes with other problems. So if you actually read about the environmental impact of those dams, it's significant. They're changing whole ecosystems there to create these dams. You also have concerns around droughts and changes in rain that might come from climate change that makes dams less productive. Certainly, we've seen that, as I mentioned, in the west of the U.S. Wind and solar are great options, right? It takes a lot of time to do that. We talked about how hard it is to get some of those that supply chain for solar. The problem with wind is that people don't realize this, but all these renewables have to be renewed themselves. The blades on the big windmills you see out in these fields, particularly in the middle part of the country, have to be replaced roughly every 20, 25 years. The gearbox that sits at the back of those is about a 10-year lifespan. And those are fairly energy intensive to make. There's a lot of composites that go into those blades to ship them, et cetera. So there's still a lot of costs there, and we still haven't built out enough. People don't realize it, but all the billions of dollars we spent in this country in renewables, 1990, 12% of our renewables, of our electricity came from renewable sources. Fast forward to today, actually 2022 is the last available data that I saw, it's only 21%. So 30 plus years, a lot of investment, billions of dollars. We've only increased our renewable component of the electric grid to 21% from 12 in 1990. Biofuels, people talk about. The problem with biofuels is they're not quite as clean as I think, they say the renewables like wind and solar. And they're also anywhere between 50 and 300% more expensive than conventional fuels. For better or worse, I think a lot of people are looking at natural gas, actually, because there's a huge arbitrage play right now in natural gas. It's very cheap relative to almost any other energy source right now.
Why is that? Why is it so cheap? And I think, why are drillers giving stuff away in Texas? What's going on there?
Right now, the Henry Hub natural gas prices for 1 million BTU is a little over $2. In West Texas, near El Paso, it's negative $1.50 for the same 1 million BTU. So why is nat gas cheap overall? It's harder to handle than oil, right? It has a lot more volume to it. And in order to get it to a volume that you can ship, that's why you hear about liquefied natural gas. You have to chill it to negative 270 Fahrenheit, which is the point at which natural gas goes from a gas form that we all know it to a liquid form. And it's about 600 times more dense. So that's how you're able to ship it. But there's a cost to do that. And there's, facilities have to be built to facilitate it. So what's going on in West Texas in particular, and also in the Dakotas, is you've got a pickup in oil drilling from the shale boom that we've had. And what those drillers really want is oil, because oil, so today oil's, depending on what oil you look at, $78 to $83 in that ballpark between West Texas Intermediate and Brent. The equivalent energy output from nat gas would be equivalent of around $12 a barrel of oil. So in other words, $12 in nat gas right now gets you the same energy as $80 roughly in a barrel of oil, to put things into context. The reality is these drillers don't really want the natural gas. It comes out of these wells when they're fracking, and they don't know what to do with it. There are two issues around it. They used to just flare it off, but the EPA has really cracked down on flaring, because that's obviously a waste of energy and it's not good for the environment. So they're requiring a lot more sequestering and usage of that nat gas, but there's a lot of pipeline issues. So there's a new pipeline called the Matterhorn pipeline. It's going to run through West Texas from roughly Wharton and Katy, Texas, out to the West Texas area where they're giving away nat gas. That's supposed to be completed the later part of this year. So you'll probably see a little bit of that arbitrage between West Texas and the Henry Hub dissipate. But nat gas is still going to be relatively cheap. It's just cheap as it's ever been relative to oil right now, but it's always been cheaper. It's also the most energy dense and the cleanest burning of all the hydrocarbons. So there are a lot of people who are looking at nat gas and how to use it in low emission or even zero emission ways. And I'll give you an example. There is a new power plant that's being built in West Texas by a company called Net Power. They've built a new natural gas turbine that's designed to operate in a 100% oxygen environment. When you do that, there's only two byproducts that come out of there, very clean burning. It's CO2 and it's water. Okay, that's all that comes out. They're able to sequester much more easily that CO2 because they're burning it in a cleaner environment, much easier to identify it, pump that CO2 back into the other end of the nat gas well. So out of one side comes nat gas, generates a substantial amount of energy. Energy goes out into the electric grid, and then the back end of it goes to CO2 that helps repressurize that nat gas, and it'll stay there, in theory, indefinitely. So there's a lot of, developments that are like that. Cummins engines come out with a flex fuel that you can literally run a diesel engine. You can run the engine on diesel, or you can switch to compressed natural gas if you have access to that. Compressed natural gas retail market right now is equivalent around 50 cents a gallon. So instead of paying $4.50 at the pump, you can pay 50 cents a gallon. That's how inexpensive nat gas is. And it's really a byproduct of pipelines not reaching out that far, the higher cost of handling natural gas, and it's a byproduct from oil drilling.
So that sounds like a great story in terms of how we could see possibly a reduction in at least some energy costs. But we've talked in the past about how energy is becoming more expensive in some areas, and could potentially be impacting the continued pressure on interest rates. And so just wondering, any thoughts? We've seen feels like earlier in the year we talked about interest rates. There was an assumption of a certain number of rate cuts. And that seems to have continued to, go in the other direction. Well, maybe not in the other direction, but I suppose slow down the enthusiasm around expected number of rate cuts. And now, what we're hearing from the Fed is, okay, well, we're not going to raise rates. Well, that sounds good. Keeping in mind, we're recording this early in May, and who knows, where things, could end up. But what are your thoughts on how this could play out with the rest of the year?
I think we talked about this at prior podcasts. I think we're in a secular period of higher for longer interest rates. And it's taken the market a long time to realize that the first cuts were actually predicted by the market in July of 2023. And I remember we recorded this podcast in December of late last year, December of 2023. There was a 90% probability that the first rate cut was going to happen in March of this year. And I think there were going to be 6 of them over the course of the year. Of course, that's not come to fruition. There are a number of issues going on right now that are driving inflation higher. We've talked about some of them in the past. The tight labor market. I think the fact, too, that a lot of the wage inflation that you've seen, and this is a little unusual, if you actually look at wage inflation, the low wage earners, the lower quartile, has been, had the highest wage increases. The lower wage quartile is typically one to spend what they earn, right? They're not saving it necessarily, and they tend to spend it on things like, durables like cars and so forth, whereas the higher wage earners are going to, save that money, or maybe they spend that more on vacations or, overseas trips and things of that nature that might not go back into the economy as directly. So that's positive. I still think higher energy prices are going to continue. To put things in perspective, and energy prices where we've come from, the average electricity price in the United States 20 years ago was approximately 9.1 cents per kilowatt hour. In 2021, it was 13.8, right? Today, it's 17.4. So they've already gone up a lot, and that's with electricity demand flat over the last 20 years, right? Now, granted, oil prices a little bit higher, costs are a little bit higher, but we've also pivoted from 17% natural gas feeding our electricity grid in 2004 to today in 2024, it's a little over 40% from natural gas. So, we have had some inputs come into that are much cheaper to, in theory, offset some of those energy costs going up. So I think higher energy is going to continue to drive inflation. I think this geopolitical situation is definitely going to drive inflation higher. And the reason is we've moved already, I think it's already a move that's happened from a unipolar world over the last 30 years to multipolar. And anytime you start to break down the global trade, moving production to the lowest cost markets, and you start this multipolar onshoring, reshoring, whatever you want to call it, resilient supply chain, et cetera, it just makes the world less efficient and productive, and it's going to drive cost higher. I look at the election that's going to happen in the U.S. this year. You're going to have a choice of, essentially, there's a populist movement. You're going to have a choice of two presidents that are probably going to drive inflation higher. Biden's already done with the CHIPS Act and the, student debt reductions, et cetera. I'm not arguing the merits of those, but those are inflationary. If Trump gets elected, right, you're looking at closing the border, inflationary. You're looking at increasing tariffs, inflationary. You're looking at probably extending his tax cuts or maybe even lowering them more, inflationary. And what's really, at the end of the day, yes, we've had some monetary tightening, but the fiscal stimulus that's going on not just in the U.S., but Europe, India, China, right? It's overwhelming significantly the monetary tightening. And I don't envision a scenario in the near future where fiscal spending starts to decline because we see all these populist movements, not just in this country, but others.
And so we talk about higher for longer with interest rates, and that primarily because we're not seeing the reduction of inflation that the Fed wants. I still wonder, the Fed's target of 2%, which anybody that does a little bit of research realize that number was pulled out of thin air, by somebody in New Zealand, in the 1980s. So why that? What's so magical about 2%? Do we really need to get there?
No, 2%. You're right. In 1988, there was an interview with one of the governors for the New Zealand Central Bank, and they had a real inflation problem in the 80s, and he apparently made some flippant comment on a TV camera about that their target's 2%. They hit the 2% number eventually, and everyone said, "Oh my gosh, what a great success!" And that's what we need to emulate. The U.S. formally adopted that 2% target, I think, later in the 90s, if I recall, or early aughts. But at any rate, it's the number everybody uses now. It has no research or basis whatsoever. There's no way we get to 2% number without energy costs being markedly cheaper. And we just talked about why I don't think that's going to happen. So what's most interesting, though, and the reason that I really, and I've talked about this in the past too, that I think the BLS CPI is not a very accurate gauge. And it's a tough thing to try to figure out what's inflation on a national level. But there was actually a change that I didn't realize until I read this paper that was published recently by Larry Summers. There was a change in 1983 with the way that interest was reflected in the CPI in the United States. In 1983, they stopped using interest inputs, whatever the interest rate was, because they felt like it was overstating what the CPI was showing in the late 70s and early 80s. And they came up with this concept called owner equivalent rent, which basically suggests that the cost of my housing is equal to what I would rent my house out if I was to rent my house out instead of live in it, which is a sort of curious way of doing it. Larry Summers and some other academics went back just in February of this year and said, well, what if we used the pre-1983 calculations, the one we used in the 70s and early 80s, to calculate inflation today? And what they found is that same calculation would suggest that inflation in the United States is over 7% today. And that kind of explains, to a degree, why you hear a lot of Americans complain still about inflation, even though the headline CPI numbers are kind of in the mid to high threes, which seems somewhat benign. It's not quite to the 2 they want, but it's getting to that level. And the Fed has made some progress in limiting inflation. But the Larry Summers piece suggests that it was 18% at a peak, much higher than where the federal government, the BLS, will tell you that it peaked, and it's still 7% today. Probably the truth's in the middle somewhere. The fact that the CPI today, which I didn't really realize until recently, until I read this paper, doesn't reflect the interest on cars, on homes, on credit cards, and that's what consumers, especially moderate, lower wage earners, are really being handcuffed with. It makes sense why inflation's probably running higher today than they realize. The 2% number, like you said, pulled out of thin air. It's going to be really hard to get to if these energy prices are doing anything that we would expect them to see.
Yeah. And then, just shifting maybe away from, interest rates, but, so U.S. monetary policy, what potential impact could that have on global markets?
So the monetary policy is restrictive right now. It's not, we still actually have a fairly loose overall policy because of all the fiscal spending that's going on. I mean, just think about, I think the U.S. government's on pace to spend about $1 trillion in interest alone. So that's income in people's pockets. That's inflationary, not to mention all the policies that we're pursuing. So that's really overwhelmed the monetary tightening, which is why you still see pretty decent growth in the U.S. Today, at least. There was a piece that Barclays actually put out recently, and they actually looked at the impact of the monetary policy in the U.S. and how it impacts the world. And what they concluded is that, on average, a 100 basis point increase in U.S. yields and on treasuries is about a 40 to 50 basis point impact on G10, but especially high among, obviously, Canada, Australia, and the UK. There's about a 77% correlation in long-term rates they found. So as the U.S. keeps monetary policy higher, keeps interest rate higher, it does have an impact in these other countries. It also creates a fairly strong dollar right now, so we're still seeing a relatively strong dollar. They're going to have to stay at that policy, but I think they'll actually might even see interest rates tick up here. We've had a lot of weak Treasury auctions recently. So on May 8th, the 10-year auction was $42 billion, which is a record in terms of the amount of 10 years that are being issued in one auction. Not surprising given the amount of fiscal spending and debt we're accumulating. It was fairly weak. It wasn't a historically bad auction by any means, but the pre-auction indications ended up being 10 basis points higher on the actual results of the auction that happened on the 8th. A month ago in April, we would have what I would consider a much worse auction. So we've had a series of these recently, starting late last year. And so that's probably going to continue to put some upward pressure on rates in the interim as well, I think, just because of the sheer volume that the federal government's issuing in debt.
Yeah. And then what's the impact of that? Think of the higher for longer on think about, some of our clients and they're thinking about their investment strategies. What are they having to do differently in order to adjust to this, this new environment?
Well, I think I would encourage people to ask themselves three questions, because I don't have the crystal ball. I think you have to ask first, will higher yields stop growth? So if higher yields are going to limit growth, you probably want to move money in U.S. Treasuries, right? So second question is, will the economic polarization continue? So if you expect economic polarization, we haven't talked a lot about this in the podcast, but if you expect China to do more trade with emerging market countries, for the West to maybe not be as big a part of that, right? If you expect that, you probably want to buy emerging markets. You want to buy probably emerging market debt, which has performed extremely well the last few years. You probably want to buy gold, probably want some commodity exposure, right? These are areas that tend to do well when emerging markets do well. And you probably want to invest in defense stocks. If you believe that fiscal spending will stay high, right? You, again, probably want to buy gold, probably want to have some commodity exposure, and you probably want to look at value stocks. Value tends to do well when fiscal spending and inflation does higher. It doesn't do as well for growth. And then the opposite of those, right? You think about, all right, if fiscal spending declines, which I find highly unlikely, okay, what might that mean? You probably don't want to buy stocks that have a lot of exposure to government spending, for example. So those are kind of the three questions that are in my mind right now. I think the big one is, will higher interest rates really cap growth? Because that's a very different answer than fiscal spending continuing. You're going to get two completely different answers there. And I think that's the crux of what's happening right now, is this interplay between the monetary tightening and the fiscal stimulation that's happening. And so far, fiscal is winning out.
Got it. Well, Grant, I think, it's really, fascinating discussion today. Somehow we managed to bring AI, interest rates, energy prices all together in the same conversation. Any last thoughts from you on just, for our listeners on what they can expect in markets over the coming weeks?
I'd like to talk about gold really quickly. So gold's something that we've talked about a few times this podcast. I mean, it was in January that I made the statement that if there's a year that gold's going to break out, this is going to be the year, and that's exactly what's happened. So I've gotten a lot of questions on that since then, what's going on in the gold market, what's happening. So we are seeing, by and large, very few investors in the U.S. with any real exposure to gold. In fact, gold ETF holdings in the U.S. have generally been declining over the last 2 to 3 years. They've started to pick up a little bit recently, but even in this year, the beginning of this year, we were still seeing U.S. investors exit gold. So if I look at the gold market and the entire history of the humankind, there's roughly $16 trillion of gold mined at today's prices, roughly $2,300 an ounce. The paper market for gold varies, but it's 200 to 300 trillion. It's all cash settled, mostly in London, but it's a multiple of the actual supply of gold. So keep that in your mind. Then you've got, I think, 2, maybe 3 central banks in the world that have more than 10% of their reserves in gold. All right. China doesn't. India doesn't. Right. Most European countries do not. If any of these mix of countries decides they want to build up to 10% reserve, it would literally take of that 16 trillion that I told you about, it would take more than half of that for them to build those types of reserves. So if you look at the first quarter of 2024, there was something like 290 tons of gold that was bought by central banks, predominantly China and emerging markets. That represents almost half of the mined production over that same time period. It's probably about a third, up to be exact. So a lot of the mining is going straight into the central banks. You also have a lot of retail investors that are buying gold, particularly in emerging markets. If you think about the Chinese right now, you got the Year of the Dragon, so it's a big year. There's a lot of gold buying that's from that. But also, if you're Chinese, the real estate market's obviously not doing well. You can't buy real estate so much in the Western world, so that's why you haven't seen Chinese investors buying in Vancouver and Seattle and San Fran. Why? Because they don't want to be cut out from those assets in the same way that we cut a lot of wealthy Russians out of those assets, at the outset of the Ukrainian invasion. So one of the things they're buying is gold. So you're seeing it in physical with the retail investors in emerging markets. You're seeing it at the central bank level. It's a mass amount of gold. There's just not that much supply of gold. Unlike Bitcoin, which is a risk-on asset, has a high correlation to tech, gold's also still a safe haven. And I think if people are worried about whatever they're worried about in the world, they're going to also tend to buy gold. So there's a lot of action still going on in gold. There are a lot of people who feel like it's still got a lot of room to grow. It's still 40% lower than its last peak, inflation adjusted. So, you might still see, some continuing buying in gold. So I think that's one trend to mention. In the equity markets, we haven't really talked about that. One good trend is insider buying has been relatively strong. So that's a good sign for the market. Retail sentiment's a little bit lower, but it's flat. So if you look at the AAII, retail sentiment poll, it's neutral right now. Last time I was on this podcast in February, it was very positive. Retail investors have been selling a little bit, which is why you saw some weakness in April. The value stocks still very cheap. So I'm still looking at a potential pivot in a higher inflation environment from growth to value. That still has not happened yet. And I think the concern I've got in the market right now is we are due for some, maybe a small correction. I don't envision any major recessions or sell-offs in the near future. But if there is a bit of a sell-off, the concentration that we saw on the way up, the Max 7, it's going to be the same thing potentially on the way down. It could be a lot of people rolling out of these stocks at the same time, and it might be the same sort of exaggerated effect on the way down. So that's something to also keep an eye on.
Well, great. I think those are great insights, as usual. Really interesting discussion. And as always, I want to say a big thank you to our listeners and look forward to seeing you on the next edition of Market Pulse by Faster Forward at Northern Trust Asset Servicing.